Lesson 3, Underwriting Deep Dive. In our Underwriting Deep Dive, we're going to talk about credit risk and assessment. We're going to talk about income and employment, as well as borrowers' assets and collateral. These are the 4 main criteria for underwriting a file for your customer. And so for credit risk and assessment, some of the things that we're looking for, and again, I want to make sure that I reiterate to you that the loan officer is the first person to qualify your borrower. Most loan officers should have a broad understanding of underwriting guidelines. So even though we're calling this an underwriting deep dive, the loan officer really is that first person to qualify your customer. So underwriting is going to be looking at the credit risk and assessment. They're looking to make sure, first and foremost, does your borrower meet the minimum credit score requirement for the product that we're applying for? So when we're submitting a file or we're reviewing a borrower's credit, the first thing that we want to make sure is that they've met the minimum credit score, because if we're not meeting the minimum credit score, we can't go any further, right? And so every product and program, whether it be FHA, VA, USDA, conforming programs, all have their own minimum credit scoring criteria. We're also going to be analyzing the borrower's collections, judgments, whether or not they've ever filed bankruptcy, had a property foreclosed on, or if they've had any other major derogatory events reporting on their credit. Some programs have a minimum of a 2-year discharge for bankruptcy before the borrower can qualify for a new mortgage. Some of them are a minimum of 4 years. So when we're applying for that loan, we're looking to see, okay, if they've filed bankruptcy, how long has it been since they filed, and do they qualify or meet the minimum criteria for this particular program? For collection accounts, depending on what type of collection account it is, sometimes our automated underwriting system will tell us this collection account needs to be paid off before we can proceed. Other major derogatory events, such as judgments, may require that the judgment be paid off before we can proceed. So when we're analyzing that credit, these are the kind of things that we're looking for. In addition to that, we're also looking at the borrower's payment history. There are some products that do allow for a borrower to have mortgage late payments on their credit within the last year. And then there are limits on it as to how many lates they can have before it would require that we not be able to approve that file, or we would have to downgrade it to a manual underwrite to see if we can proceed. We're also looking at that borrower's credit utilization and credit inquiries to see how are they using their credit, and if there's any recommendations maybe that we have for them to help them just put them in a better financial situation. The underwriter is also looking at a layering of risk. And if you've never heard this term before, this really comes in when we're talking about a file that has to be manually underwritten versus getting the approval on that automated underwriting system. So if you remember, I mentioned that sometimes we'll get a finding from that automated underwriting system that is called refer eligible. And that means that that file has to be submitted to an actual underwriter to do a manual underwrite. And at that point in time, that underwriter is going to look at all of the layers of risk associated with this particular customer. Now, let's say, for example, the borrower has a low credit score. Maybe their credit score is 580. But instead of having just the minimum amount to put down on an FHA loan of 3.5%, let's say they've got 10% to put down. So that's a compensating factor and kind of adds to that positive layering of risk. Now, let's look at the opposite. We've got that same customer with a 580 credit score. They've got minimum down. Their debt to income ratios are really high, and that would be a negative layering of risk. Okay, so the underwriter is looking at all of these different factors when they're evaluating your customer's credit. And then the last thing that we want to talk about is lender overlays. The best way for me to describe a lender overlay is if Fannie Mae and Freddie Mac have a baseline of credit guidelines that they require. A lender overlay is a risk tolerance that is layered on top of that, okay? So if a minimum credit score on a conventional program is 620, but ABC Bank says, you know what, we just don't like the risk associated with a minimum credit score of 620, so we're going to make our minimum credit score 650 for this particular program. That is a lender overlay. And lenders can add overlays as they see fit to mitigate their risk, but they have to meet the minimum requirements set forth by the investor. So when a borrower, one of your borrowers, goes into a bank and they apply for a loan, and let's say their loan was denied and the banker says, I'm sorry, but your credit score is only a 580 and we can only do FHA loans if your score is a minimum of 620 or higher. That does not mean that your customer can't get approved. It just means that that particular bank's credit overlays do not allow for them to approve that customer. So it's always important to make sure that you're having conversations with your customers that, hey, just because you got denied at one bank doesn't mean that you would get denied at another. So make sure that you ask questions and have a trusted lender that you can go to for your customers that you know are going to point them in the right direction. Income and employment. When an underwriter is reviewing a borrower's income, first of all, they're looking to see what type of income is it? Is this borrower a W-2 borrower? Are they self-employed? Do we need pay stubs or do we need full tax returns? So they're looking to make sure that the loan originator has supplied the appropriate documentation based on the borrower's income status, the product, and the program that they're applying for. They're going to review that information and request additional documents if needed. But the three key things that an underwriter is looking for when they're reviewing income and employment history is number one, stability. Number two, that income is likely to continue and that the income is predictable. So it's likely to stay the same. And so a lot of times we will come up against challenges where a borrower will tell us, well, I was told that I couldn't get a loan because I haven't been employed at the same place for 2 years. Well, that's not necessarily true. A 2-year history is required, but that 2-year history does not always have to be with the same employer. As long as we can show that the income is stable, likely to continue, and is predictable, then we can use a history that spans 2 years, but maybe with multiple employers. So with the stability, again, we're looking at, is that income stable? Is it likely to continue, and is it likely to continue at that predictable rate? That's primarily what we're looking for. Now, that 2-year history can also be as a student. Maybe you're just getting out of college, you've saved some money, you'd really like to buy a house, but you just got your first job and you just started. We can use your college transcripts to document part of your 2-year history when you start a new job. So having a conversation with a lender about what your borrower's particular circumstances are is very important. Don't just assume that they can't get approved because they don't have a long enough work history. So again, we're looking at, is that borrower employed or self-employed? That's going to tell us what type of documentation we need. And then we're also looking at the borrower's debt to income ratio. How much money does the borrower make versus how much debt they have? And we're making sure that they have sufficient income to cover the debt as well as the new house payment that they're applying for. Assets is the next category in our underwriting deep dive that we're going to cover. Assets are any funds that we have to verify that the borrower is going to be using for the transaction. So their funds to close all have to be verified. We have to validate the source of any funds being used. That includes the cash that they need for closing for their down payment, closing costs, property taxes, homeowners insurance, and not only that, but any reserves that are required. Some programs require that a borrower have reserves left after they've settled their transaction, and it requires that they have funds left over just in case anything were to happen, they've got sufficient assets to support them to help them continue to make the house payment on time. We document reserves typically in the number of months. So if a borrower's monthly house payment is $1,000 a month and we need 2 months worth of reserves, then they need $1,000 times 2, so $2,000 in reserves left over after they have paid all of their closing costs in order to still close on the loan. Large deposits also need to be validated. Large deposits are typically considered anything over 50% of your borrower's gross monthly income. So if your borrower makes $5,000 a month, then a large deposit would be any deposits over $2,500 or any deposits that seem just really out of the norm, that are in excess of that. Large deposits have to be sourced because housing is one of the ways that criminals will typically launder money. And so the investors require that we are stewards of anti-money laundering. And we have to document the source of any funds coming in and out of that transaction that are being used to purchase a home. Now, funds can be considered seasoned if they've been maintained in account for 2 bank statement cycles or 60 days. So if a customer says to you, hey, I've got, this money and it's at home, it should be an instant red flag for you to have that conversation with the customer. Hey, you need to talk to your lender about how you can use that money and suggest that perhaps they put it into a bank account to make sure that that money is seasoned prior to finding a home. But I would definitely consult a lender because they're going to give you the best advice on how to handle that. Lastly is gift funds. Gift funds are an acceptable source of an asset depending on the transaction and can be given to a borrower by a family member and in some cases a close friend. Gift funds do have to be documented as well, typically using a gift letter from the donor stating that there is no expectation of repayment of those funds, and then documenting that the funds actually came from the donor. And typically we do this via a canceled check. Donor writes a check. Once the check is deposited, they get a copy of a canceled check, and that is sufficient to document the source of those funds. Collateral. When determining if a property meets minimum property standards, an underwriter is going to review an appraisal report. They're going to be looking to make sure that that property is in the minimum condition that is expected per the guidelines of the program that we're using. Now, in some cases, you will have a property appraisal that comes back and it says, hey, this property is at value that we expected, but it's subject to some repairs. And those repairs can be anything from peeling paint to GFI switches or handrails or broken glass. Those are just some examples of some of the things that we will typically see. Minimum property standards almost always revolve around health and safety issues associated with the property. The investors want to make sure that the property that you're purchasing meets minimum health and safety standards. And so anytime you have a property appraisal that comes back and it's for something that's cosmetic or maintenance other than things like roofs, major items, it's okay to question that with the lender and say, hey, are you sure that this is required in order for us to close on the loan? Because typically they are health and safety issues. In addition to that, there are some differences between conforming and government minimum property standards. Now again, most of them all revolve around health and safety concerns, but FHA may have a few additional conditions that you wouldn't necessarily find on a conforming loan. A great example of this is peeling paint. FHA requires that any house built prior to 1978, when they were still using lead in lead-based paint, that if there's peeling, chipping paint anywhere inside the home or outside of the home, that paint has to be scraped and repainted. That would be one of the differences between FHA and conforming. VA requires pest inspections. So anytime you are purchasing a home using a VA loan, it's going to require a pest inspection. And if there is any damage that is present or any evidence that there has been an infestation, it will require treatment and possibly further inspection to make sure that there has been no structural damage done to the home. So these are just some of the differences that you might see between a conforming and a government loan. On collateral, some lenders will use an AMC to order their appraisals versus an independent panel of appraisers. Most lenders have transitioned to an AMC, whether it be an in-house AMC, and AMC means appraisal management company. Some of them are in-house appraisal management companies, and then some of them are third-party companies. And so when we're ordering those appraisals to evaluate the collateral on the, for the home buyer, those appraisals would be ordered through one of those channels. And then like we talked about, there's also the PIW, Property Inspection Waiver. And if you're lucky enough to get a PIW, then they're not even looking at the collateral. They're basing it strictly on the fact that Fannie Mae, Freddie Mac has enough data to say that this property is worth what it needs to be worth. For property repairs, anytime you have an appraisal that comes in that is subject to the repairs being completed, those repairs do have to be completed prior to closing. In some cases, those repairs could be outside repairs involving paint or cement. So if it's during weather like we're having right now, where it's 20 degrees outside, it's likely you're not going to be able to make those repairs prior to closing. So when you have a weather-related repair, it's okay to ask for a weather-related repair escrow. When we're doing a weather-related repair escrow, the money for those repairs is getting set aside into an escrow account, and those funds are held in that escrow account until the repairs are completed, we can close on the loan, and then the funds get released later on. If you have additional questions about this, I would highly suggest contacting your lender partner.